You need more coffee for this presentation, I'm telling you. There's going to be a lot of charts coming. There we go. Just a moment delay here. Do you have some jokes? I will get fired. Just waiting for some slides here. Is there one from Toronto? Anyone outside of Toronto? Where are you from? Vancouver. Excellent. When did you come in? Wow. And with the time zone change, you're wide awake? Very good. What is it? I'll wake you up. Yeah, there's lots to go on here. Anyone else out east? Oh, we're representing the west here. We got the east here and everyone else in the middle. I think we've got a presentation. Excellent. Let's try this again. So again, thank you so much for coming out. We talked about how excited I am. We're going to talk about the economy, the state of the industry. I have to, and there's a lot of unfamiliar faces here, so for the uninitiated that are out there that are not familiar with my presentation style, I do need to warn you about a couple of things. First and foremost, my clicker's working. So I am a huge heavy metal fan. Been since I was 15 years old. So because of that, stage diving, crowd surfing, mosh pits are always encouraged during my economics presentations. So I'm warning everybody in the front row, you may have to be catching me after this presentation. So I also use this as inspiration. So later on in the presentation, I'll be circling back to metal music because I'll be using that to talk about how restaurant operators can manage through the economic recovery. Now, as much as I love metal, I love working with data, working with numbers. And so you're going to be seeing and bombarded with a lot of charts and tables this morning. Now, in the old days, a lot of my charts were relatively simple line graphs, just like this. You'd see a few ups and downs, but they generally followed along a stable trend line. But in today's food service industry, it's a lot much more complicated. As restaurant operators are trying to rebuild their sales, they're dealing with these chronic labor shortages, which are driving up wages. And at the same time, soaring food costs, rising utility prices, rent keeps going up. Traffic has not come back to normal yet. Delivery and takeout are continuing to change the food service landscape. And on top of all that, restaurant operators are making less money and going more into debt. So this is sort of the world that we now live in. A lot more complexity and a lot less certainty. So what I want to do today is really break this presentation into two parts. The first part, I want to talk about the state of the economy. And because this is such an important component, because so much of what happens in the economy has a direct impact on food service sales, I'll be spending about half my time here. I think this is so important given what we're going through. And then from there, in the second half, I'll talk about how that economy is going to impact food service sales and what we're going to see with the latest consumer trends, and then I'll provide you with our latest food service sales forecast. Sound good? Okay. So, state of the economy, and really, I want to tackle three questions here. The first one is, how did we get here in the first place? When we were here 12 months ago, we were full of optimism, growing economy, this is going to be the roaring 20s all over again, right? But how do we go from that to 12 months later, now we're talking about an economic slowdown? So that'll be the first thing, is how did we get here? The second part is it going to be an economic slowdown, or are we going to see a recession? So I want to tackle that. What would the impact be on I want to talk about here? But the first place to start, obviously, has got to be with inflation. Inflation has been the number one economic news story for the last 12 months. We've all been talking about it. So we're going to start our presentation there. So when we look at overall inflation back in 2019, what we saw is inflation was around 2% per year over year. And this is in line with what the Bank of Canada's target rate is for inflation. The Bank of Canada has picked 2% as the optimal inflation rate for steady long-term economic growth. So that's why we want to see inflation hover around that target level. And we did see that in 2019. Now with the reopening of the economy, we saw inflation jump to 3.4%. This is the highest level since 2011. But we have never shut down a global economy before and then reopened. This has never been done before. And so what happened is there was a lot of massive amounts of supply disruption. People couldn't get products. That led to inflation. It's understandable. And then when you have the war in Ukraine on top of that, all of that contributed to higher inflation. Now, since then, we have seen a steady drop in inflation down to 5.2%. This is largely because of a 30% decrease in gasoline prices. So right now, you're probably thinking, well, the Bank of Canada is going to be happy with this. Headline inflation's coming down. But the volatility of energy. And what we see is that back in 2019, core inflation was hovering around the target rate that they wanted to be at. But what we've seen is, despite the fact that we've seen rapid increases in the interest rate, core inflation is still relatively high. It has come down a little bit, but certainly the Bank of Canada is not happy with the core inflation being this high. Now, we have seen a drop in the goods side of the economy, but it's the services sector, such as restaurants, travel, accommodation, tourism. All of that is keeping core inflation above the target level. So the expectation is that we are going to start to see a steady decline in the core inflation and the overall inflation. So when are we going to get this relief? So if we take that monthly data, we just convert it to quarterly because this is how it's forecasted. We see at the end of the fourth quarter, we had overall inflation at 6.6%. That's expected to drop to 5.4% in the first quarter, so that by the end of 2023, we're looking at inflation around 3%, which is the upper bound of the Bank of Canada's target range. This is a good thing, and then by the end of 2024, we'll see inflation drop to about 2%, which is again right on target. This is a good news story for a lot of restaurant operators because a lot of the products that you're buying, you're not going to see that high inflation rate that we've been seeing. Now, the downside to that, though, is that food inflation is going to remain high for at least the next 6 months. This is largely because of supply issues, energy prices, transportation costs remain high, processing costs remain high. So we're going to still see food prices in that 5 to 7% range. But overall, we are going to see that reduction in overall inflation, which is a good thing. So how did we get to lower inflation? Well, the only way that the Bank of Canada knows how is we have to raise interest rates. So what we see since 2000 is the overnight target rate that the Bank of Canada uses to run monetary policy. If the higher you raise interest rates, the slower the economy goes. The lower the interest rates, the more injection of liquidity that you're putting into the economy. But what we saw is that for the better part of a decade, we've been used to low interest rates. Interest rates were never above 2%. And so this fueled a lot of debt borrowing, and that, of course, led to a lot of household debt. But what we have seen is really, in the last 12 months, a significant increase in interest rates. We've all been familiar with this. But there's a reason why the Bank of Canada has been so aggressive in these interest rate hikes. What's happened is they are front-end loading these interest rate hikes because it takes about 18 to 24 months for these interest rate hikes to work their way through the economy. And so if you want to have the most immediate impact, you have to be raising interest rates at a very fast clip. The second reason why the Bank of Canada is doing this is credibility. It's all about getting the general public to understand that their goal is to get inflation back down to 2% target. If they do not do this, what we're going to start to see is a wage price spiral. In other words, if we start to see high inflation every time that we go out, you're going to ask your employer for higher wages, which leads to higher costs, which then leads to higher inflation. And so if we see 5-6% inflation every year, costs are going to go up 5 or 6%. So we're just in this endless cycle of higher wages, higher prices, higher wages, higher prices. So the Bank of Canada's goal is to get inflation back down to 2% so that we can break that cycle. Now, overall, big question on everybody's mind seems to be, will we see a Bank of Canada interest rate cut? We're talking about an economic slowdown. Right now, the Bank of Canada has put a conditional pause on interest rate hikes. If we don't see core inflation come down, if that starts to rise, if overall inflation starts to rise, we will see another interest rate hike. They're meeting tomorrow. It's expected that interest rates will remain flat and will continue to be flat basically till the end of the year, and then we'll start to see some declines in the interest rates early next year. But for the time being, don't expect any more increases, but also don't expect any decreases. So the reason why they're doing this is they're trying to slow down the demand side of the economy so that the supply side can catch up. And they have been effective at doing this. If we look at really the last half of 2021, we saw the strongest economic growth of the G7 countries, and our economy actually was outpacing the Chinese economy. This is how fast GDP was growing. Now, of course, we saw in the first quarter the impact of Omicron, so that brought down overall GDP. But then you see as the interest rates started to take effect, Q2 we started to see a slowdown, Q3 even more, and then generally flat economic growth in Q4. Now the reason why we saw this was actually not because consumers were pulling back on spending. When we look at overall real GDP consumer spending growth, what we see is it's actually about 2%. Historically, this is on par with what we've seen. Typically, we would see consumer spending grow around 2.5, 2.8%. So the fact that it's still at 2% shows that consumers are still outspending. Where we are seeing the declines in the economy are in the interest rate sensitive parts of the economy, housing and business investment. Housing is in recession. Business investment is in recession. Consumers are not, but those two segments are currently in recession. Housing has dropped for 3 consecutive quarters. The business investment is down 2 consecutive quarters. So those parts of the economy are dragging down overall GDP. And it'll just be a matter of time before we start to see that in consumer spending too. So in terms of the outlook, we finished Q4 with generally flat economic growth. Consumer spending is still relatively strong, so we'll start to run the economy 2% decline quarters. What you are not seeing in this overall, we will see a painful economic slowdown. There's upside and downside risks. And I think one of the big concerns is this would be very alarming. And that would start to really have a direct impact on the overall economy and certainly on the food service industry. So what I've shown here with the yellow line is really sort of that trend line going forward of where the housing prices should be. And we can see that we're still above that trend line. But if we start to fall below that trend line, we see another 10% drop in housing prices, that's going to seriously impact the wealth of Canadians, and that wealth effect will certainly have a direct impact on restaurant operators. What we've seen in the past is 2018, 2019, is that because of higher housing prices, people went out to restaurants and spent a lot more, even though we saw flat disposable income. So wealth effect is certainly a big issue, and it certainly has a direct impact on food service operators. So to me, this is the biggest risk to all these increases in interest rates. Another risk is on the employment side, but actually this has been a positive risk. What we see with the chronic labor shortages is that we are having companies hold on to employees for dear life. Before any other recession in the past, anytime we would talk about a recession, what we would see is we start to see layoffs in the news. We're not seeing that this time around. In our industry alone, we had 160,000 job vacancies, and other companies and other industries are going through that same type of a crisis. And so what they're doing is they're holding on to their staff, and this is actually going to protect the economy from seeing a much deeper recession. So overall, in Q3, we're going to start to see that decline in employment. We'll just see 3 quarters of declines, basically flat in Q4, and then we'll start to see a pickup in employment. To put this in context from where we were before, I'll just repeat the same employment numbers for the 2023, and we'll just call it recession for simplicity. And to compare that with the great global recession back in 2008 and 2009. And what you can see is a massive decline in employment. People were laying off as much as they could. They're trying to protect the industry. They're trying to protect costs. And so at that point, jobs were relatively expendable. We're going to get rid of employees, and then we can always hire them back. But because of the chronic labor shortages, we are not seeing that. And so back in the 2008-2009 recession, we had 288,000 job losses. This time around, we're only looking at about 70,000 job losses. So quite a difference in terms of scale. So because of that, the unemployment rate, which already sits at its lowest level since Stats Canada began collecting data in 1976, is at 5%. The expectation is that even at the worst part of this economic slowdown, we're only going to see unemployment go up to about 5.5%, maybe 6%. So we're not seeing that big jump in the markets. And this is certainly good news for a lot of people, but the bad news is that there's not going to be a lot of staff out there to hire. So it's going to remain a very tight labor market going forward, even in the middle of an economic slowdown. With a low unemployment rate, one of the big factors that's driving economic consumer spending is that people's wages are continuing to climb. So overall, wages grew by 4.2% last year. And this is certainly one of the strongest growth rates that we've seen in more than 2 decades. The idea is that when you have a tight labor market, that starts raising wages. And we saw that in our industry as well. We saw the second largest increase of any industry last year. In Canada overall, wages went up 6.6%. In Ontario, they were up 8.5%. So a lot of this tightness in the labor market driving up wages. The other thing that I want to point out is what I talked about earlier. The idea is that if you have inflation stuck at around 2% and expectations for inflation at 2%, you get stable wage growth. And if you were to take the average between 2018 and between 2010 and 2019, what you see is wage growth hovering around the same pace as inflation. So again, that's why the Bank of Canada wants to pick 2% so that we can have stable wage growth as well as a stable economic growth. So after all this discussion, how many people actually think we're currently in a recession? Okay. Anybody think that we're going to go into recession despite everything I talked about? Anybody think steady growth from here on out, at least for the next year? You guys are quiet. Anybody? So Angus Reid does surveys every month, and they're asking these same types of questions. And what we're finding is that 43% of Canadians actually think we are currently in a recession. Now, this is down dramatically from where it was back in October when it was 56%, but it is still quite high based on some of the numbers that you've just seen. In terms of whether we're going to go into a recession, that's still stuck about 30%, so that really hasn't changed drastically. And in terms of the ones that are holding steady, this is where we're starting to see a pickup. I think people are starting to fear less of a recession. They are seeing a break in the Bank of Canada interest rate hikes. And so this is actually a good thing if we start to see steady growth. The fear that I have is if a lot of people start to think and believe that they're going into a recession, then it becomes that self-fulfilling prophecy. People start cutting back on their spending. That means restaurants and other stores aren't making the sales, which means they start laying off employees, which means we go into a recession. And so you end up with that spiral. So this is a committed concern that there is a lot of people out there that do think we're either in a recession or we're currently going to go into one. So definitely one of the big challenges. The former Bank of Canada Governor, Stephen Poloz, said that the risk of a hard landing, so a hard landing when you go into a deep recession, has definitely gone up, given that so much has already happened and we're still waiting for the rest of the effects of those interest rate hikes to make the way through the economy. So this is, again, a big concern that people are having, that all these interest rate hikes are going to slow the economy down so much that we end up in a much deeper recession. Monetary policy is not a precise science. What you see is increases in interest rates in the hopes that you can affect inflation, but not so much that you end up in a deep recession. So that's something that they want to try and avoid. So the big question then becomes, well, what happens if there is a big recession? Are there any lessons that we can learn from that? And so if we go back to our 2008-2009 big recession, I just plotted real GDP. You can see that the recession began in the fourth quarter of 2008. This is the whole Lehman Brothers thing that started it all. Ended the first half of 2009, and then we start to see a pullout of the economic recovery in Q3 of 2009. So if I take real GDP and then I overlay real consumer spending on quick service restaurants, what you see is that in the Q4, even though we saw the first quarter of a recession, overall real spending at quick service restaurants remained positive. It wasn't until the first quarter of 2009, second quarter of 2009, we see a little bit of a pullback in real consumers in spending at quick service restaurants. But what we see as well is that as we get out of that recession, real sales start to bounce back a little bit, and then we see much stronger growth rate after that. But if this, of course, is in real terms, if I include inflation into this, overall nominal quick service restaurant sales never declined. People move from full service restaurants to quick service restaurants. And if I plot out quick service restaurant sales, you actually never actually see the impact of the economic slowdown. So if we compare that with full service restaurants, it's a much different story. So we have really this delayed impact, very shallow decline in sales, and then a very sharp impact in sales. For full service restaurants, a much different story. What we see is a much more immediate impact on full service restaurant spending and a much longer impact as well. Even though the impact of the recession was over in Q3 2009, it still took an additional 6 quarters for real full-service restaurant sales to return back to pre-pandemic, pre-recessionary levels. So we're finally starting to see some of that growth. So why is it that we see such a long road to recovery for full-service restaurants? Well, certainly the economy and the recession mean an immediate drop in food service sales, but it's the impact of the job market that has the biggest impact. So if we remove the GDP numbers and just look at overall employment, and again, my full-service restaurant sales chart, what we see is because employment continued to decline even after the recession, this dragged out the recovery in full-service restaurant sales. From the economy side, from a business side, what happens is a lot of companies, they're going to wait for the economy to fully recover before they start bringing back employees. They don't want to take a risk and bring back employees too soon. So this is where we stand in terms of the economy. This is very unlikely, which is a good thing. So food service trends, we saw our darkest winter in more than 80 years. There was 2 consecutive weeks of absolutely no sunlight in Toronto. It was a rough winter. So given all of this, I wanted to bring a little bit of sunshine to your lives. So this is a first. I have never actually had a happy slide like this in my presentation. Not used to it, a little too bright for me, but this is a good thing. And the reason why is because I'm going to tell you something for the very first time. It's official. We are now a $100 billion food service industry for the very, very first time. This was supposed to happen in 2020, but because of the pandemic, it got delayed. So finally, we are here, $100 billion in food service sales. When we talk about this, we're including restaurants, caterers, drinking places, as well as food service and accommodation institutions. And it was actually the accommodation numbers that finally came in last week that brought us to this point, so this is official. This is a big number. This is a 1 followed by 11 zeros. I work with numbers all the time. When I see numbers like this, it's hard to get my head wrapped around it. So we're going to take a little bit of a break from the charts and numbers. We're just going to talk about big numbers for a little bit, something I enjoy. So I want to put the $100 billion in perspective for you all. And the best way to do that is to scale it to something that you're familiar with, and that would be time. So if we sort of take time as sort of our measure, and then we'll talk about it in terms of seconds, minutes, years. Follow along with me for a second. So 1 second, 1/60th of a minute. For 1,000 seconds, it's about 16 minutes, which is about the same amount of time I have left in this presentation. Now, if we multiply now that times 1,000, now we're at 1,000,000, which is 11.57 days. But this is where we start to see the big jump. When we multiply 1,000,000 times 1,000, now we're at 1 billion. That's 31.71 years. This is a huge leap. And just to put that into perspective, the most popular movie 31.71 years ago was Terminator 2, Judgment Day, which was by far probably the best of the series. But we're not there yet, because now we got to multiply that times 100. But it is still a very hard thing to visualize. So let me help you with that too. If we stacked 100 billion loonies, how tall would it be? Now, as much as I am a Metalhead fan, I am also a jazz fan. I have my Oscar Peterson loonie here, which I'm really proud of. I went to the Bank of Canada. I needed 100 billion, 0.95, 100 billion. So again, just to put in perspective, this is a big, big number, and it's a really big milestone. But we're not alone, because there are other segments. You look at retail food and beverage, $170 billion. Automotive, almost $170 billion. General merchandise stores, such as the Bay, Walmart, and I can happily say again, Zellers, because I used to work there. So finally, but we're at $100 billion. This is great. This is an amazing thing. And yet, as much as this is amazing and we should all be celebrating, can't celebrate too much. Does it feel like a $100 billion industry? In some ways, yes. The numbers don't lie. It is $100 billion. But at the same time, we're doing surveys on it constantly, and we're talking to operators. Their traffic is not back to normal. Their sales are not back to normal. Their profitability isn't there. So again, it's hard to celebrate some of these numbers. Let me tell you what I mean by that. If we look at overall commercial food service sales, what we see is at the bottom we have our $100 billion in sales. This is 6% above where we were in 2023. But once we factor out inflation, we're still 6% below pre-pandemic levels. If you look at quick service restaurants, it's the largest segment of the food service industry at $38.2 billion, up an impressive 13%, and yet once you factor out inflation, real sales is just 0% or 1%. Full service restaurants used to be the largest segment in the food service industry. They were bigger than quick service restaurants. But their sales, even though it's 6% above pre-pandemic levels, overall, adjusted for inflation, they're down by 6%. And then we have caterers down 16%, drinking places such as bars, taverns, and nightclubs down 24%. So yes, overall sales may be $100 billion, but real sales still are below pre-pandemic levels. And then when we talk with restaurant operators, we ask, how was their financial performance last year? Keep it in mind that 2021, half of the industry was shut down, especially here in Ontario, because of the pandemic. And so when we talk with full-service restaurant operators, 44% said it was actually a worse year for them than 2021. How is that even possible that you could have a worse year than 2021 when sales had plummeted, people weren't going out to restaurants, a lot of restaurants were closed, and yet 44% saying it's actually worse. Quick service restaurants, that's not a problem. They could rely on takeout, delivery, they were doing well. 53%, an even higher share of quick service restaurants saying that they didn't see the financial performance that they did before. So this is a big concern for a lot of restaurant operators. And so of course we had to ask, why is this the case? And so those that said, well, things are better, this is because they saw an increase in the number of guests. I mean, we were shut down in 2021, of course we were going to see an increase in guests, so that's a good thing. Others said, well, I did have higher costs, but I could pass those higher costs off in the form of higher menu prices. And then some said we had a stronger economy. But for those that said that things were worse off, 98% said it was because of food costs, 88% said higher labor costs. So certainly not a surprise to anybody in this room. And 65% said we had fewer customers. In some cases, some of those quick service restaurant customers went out to table service restaurants. But in a lot of cases, people were still working remotely, and so we still didn't see that full return to work. So a lot of restaurant operators are still struggling. So the big question then becomes, is anybody making any money in this? And as it turns out, about 50% of the food service industry is currently not making any money. So again, that's why I said $100 billion, and yet half of the food service industry is operating at a loss or just breaking even. So overall, 34% operating at a loss, and then another 17% just breaking even, and only 12% making a pre-tax profit of 10% or more. Now, if you compare this with before the pandemic, with the blue bars, ignore the numbers for just a moment. What you see is that the blue bars are almost a mirror version of the red bars. And what we see is that back in the old days, pre-pandemic, only 7% of the industry was operating at a loss, just 5% were breaking even, and at that time, 36% were operating with a pre-tax profit of 10% or more. So we've got a long way to go in terms of a recovery. So as part of the understanding what's going on in the food service industry, we started a consumer dining index last year. Part of this is to try and provide operators with a better sense of what's happening in the industry. We would typically rely on Statistics Canada data, but there's a bit of a lag in those numbers. So with the Consumer Dining Index, it provides a little bit more foresight in terms of what's happening in food service. And much like the Consumer Confidence Index, we've just indexed this to 100 in July. But the point here is, as more people go out to restaurants, as people frequent restaurants more often, we see an increase in the index. And if people start pulling back on spending, we'll start to see a decrease in this index. And the good news is that the index has continued to increase since January. Now, as an economist, you want to say, well, this is great, but does it match reality? So when we compare this with real food service sales, we see that the two basically generally move together. So this is definitely becoming a leading indicator for us on what to expect with food service sales. So the positive news is in the first quarter, things are looking pretty good. Now we know from experience, we talked with Circana, which formerly was the NPD group, and there's three stylized facts about economics and food service sales. And the first one is that lower income consumers will feel the pricing pressure more and thus adjust food service spending more rapidly. Second, consumers will moderate their spending by skipping low-priced occasions like snacking to preserve restaurant spending, like for higher-priced occasions. And third, others will moderate the restaurant spending by downsizing their meals, cutting back on extras, searching for a deal. And of course, this will put downward pressure on their menu prices, or on the average check size, even as menu prices rise. So when we look at the dinner occasion, what we see is that there has been no impact. Despite all the talk about the recession, economic slowdown, 85% of Canadians went out to a restaurant at least once last year, or in March, and then 30% went out to a restaurant once a week or more. Even when we look at the senior citizens who are on a fixed income facing all these high inflationary pressures, there's been no change in dinner. So if we move over to lunch, what we find is that lunches continue to climb as well. And in terms of once a week or more, generally flat, but what we're seeing out of these numbers is that the 25 to 54-year-old category is driving this growth. And what seems to be happening is that they're going back to work on a more regular basis, and so they're ordering their lunches more often. And this is something that we saw in the pandemic, is that people that work remotely were more likely to cut back on their lunch. So now we're starting to see a bit of a pullback. And even if you remove the seasonal component of this, you compare it with where we were last year, it's a significant increase, especially for those that are going out at least once in the past month. So going back to the Circana notes in terms of snacking, if there is an economic slowdown, the first place we're going to see it is in the snacking category. And what we find is snacking as well has been going up. This is something that has really been driven by the younger categories, such as 18 to 24-year-olds, really driving a lot of this growth. Not only are they going out at least once a month, but they're even going out more often than that. So the 15 to 24-year-olds basically are going out about 30% on a regular basis. So again, snacking remains an important component to all this. So it's not affecting demand, but is it impacting the people that are lower income? And what we find is that, again, there's not much of an impact on lower income households. A little bit of a pullback for those that are making income less than $50,000, but certainly not significant. So what we would need to do is see another 2 or 3 months, maybe of declines, to see that that would be an indication that consumers are pulling back. But between our React survey plus the fact that we do a lot of forecasting, what we're predicting is that in the first half of 2023, we're not going to see a big pullback in food service spending. And it's not really until the second half of the year that we start to see a bit of a moderation in spending. But keep it in mind, we're not going to see a major economic slowdown, and so we're not seeing a big drop in food service sales relative to where we were in the past. We will start to see a pickup in the second half of 2024, and then sort of level off after that. Now, in terms of the segments, all segments are going to see stronger food service sales growth in 2023 compared to 2022, but keep in mind that's because we're still seeing inflation of about 5.5%. When we compare it to 2019, what we see is real food service sales are really not changing very much from where we were before. So if we add in inflation, we look at 2023 and we move it to 2024, we're looking at sales of about $92.3 billion. This is getting us closer to where we were prior to the pandemic. So that red line is what that pre-pandemic trend line and what we should be at. Certainly we see the gap in 2020 and certainly 2021, and it is starting to close, and we are starting to converge back into that 2024 level. So definitely a good thing that we're starting to see. But again, I have to warn you, just because we see that convergence in the sales does not mean that we're going to see convergence in profitability. It's still going to take a number of years for people and restaurants to pay off that debt and for restaurants to survive that. And for a lot of them, they may not have years and years to pay that back. And because I think this is such an important topic, especially for the presentation that's going to be after me on inflation, overall, we're looking at menu inflation this year of about 5.5%. This is compared to about 6.8% and certainly well above where we were prior to the pandemic, which was typically about 2.5%. So menu inflation is going to continue to be a major challenge for food service operators, largely because of higher food prices. There's just so much that we can absorb, and so restaurant operators really have no choice but to pass on some of those increases. So as I said at the beginning of the presentation, huge metal fan, and so what I want to do is just sort of use that as inspiration for you as an operator out there, really in anything that you do. Now, one of the things I've listened to, music groups like Napalm Death, Carcass, and you think, there's no way the bands that are called that, but how could they last 40 years? A lot of them because they've never compromised. They never compromised on their style of music or their lyrics. You cannot compromise either on your service and on your food. And so a lot of operators, they have to look at this and say we cannot compromise. Yes, you're going into an economic slowdown, but what we're seeing is, I've talked with Donna Dewar from Mildred's Temple Kitchen, and she put it the best. In order to save costs, you may have to cut back on toilet paper and go to single-ply toilet tissue, but do not cut back on the butter that makes your signature dish. Second thing that you need to do is keep innovating. My bands never put out the same album year after year for 20 or 30 years. They always look to innovate, and restaurant operators need to innovate too. They need to be able to incorporate technology. We saw the innovation that happened during the pandemic with retail, meal kits. So continue to look for ways to innovate, and the best source of innovation is your staff. Talk to your staff, get ideas, and some of the best ideas for your restaurant industry come out of the staff. And finally, something that my bands do extremely well is they know how to be noisy, and this is something that you need to do too. You need to keep the foot on the gas when it comes to marketing, both traditional and social media. This is so important, this is so critical, because we live in a crowded industry. We're competing with grocery, we're competing with retail, we're competing with convenience stores, and you're competing with each other. So you need to be creative and clever with a lot of your work. So on that note, I know I'm out of time, but I will be answering questions at the Restaurants Canada booth. This is my contact information. Thank you so very much. Really appreciate you coming out today. Thank you.